In this week's update, the US bond market bets the Fed made a big policy error. US stocks vulnerable to correction from Goldman Sachs, true or false? And commodities on the rebound. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. All right, let's start with this press headline, and I've got a particular reason for raising this, which is more than important. It's absolutely vital. So the headline was, and it was in an Australian mainstream publication this week, US stocks vulnerable to a correction. Now, we see these sort of headlines all the time, but what do they mean and what negative impact could they have on us? So Goldman Sachs have been quoted as saying the US stocks are priced for perfection. And Goldman Sachs is completely entitled to make those statements, and I guess the press will always report the most negative of them. But the real key here is that those sort of statements are generally out of context, and it's probably information which to the individual investor is relevant, but the danger is that the individual investor takes it on board as something that they should be mindful of. And all that can possibly do, if you've got a clear game plan, but you're a bit wishy-washy on how you implement it, then all that can do is get into your subconscious and cause you to second guess. It can cause you to hesitate. It can cause you to make mistakes. So the point of raising this is just be aware of the subtle and subconscious damage that this sort of rubbish can create. Now, unless you frequent the crowded trades, you follow the news and you go with the things that are most popular. And if you do that, then you're in a lot of trouble for a whole bunch of reasons. But for most investors, the best course of action is just not to digest this stuff at all. Just don't give it any oxygen whatsoever, because it cannot contribute positively, and it almost certainly will contribute negatively. So this is probably one of the more important lessons that I can talk about this year. Let's have a quick recap of 2024, just very briefly, because we've always got to have an understanding of what's just come before so that we can have a better understanding of what might follow. So 2024 was certainly a higher volatility year. We saw a big downdraft in August as the yen carry trade started to unwind for a whole bunch of reasons. There were massive and multiple geopolitical disruptions. I won't go through them because there are far too many, but there was probably more than what we normally saw in any particular year. Yet despite all that, the S&P still rose 23%, and the Nasdaq was up by more than 30%. Whichever way you slice it and dice it, that's an incredible outcome. And along the way, we saw the first rate cut in 4 years in September. And this ties back to the first point I made in the first slide, and that is that the bond market is betting that the Fed has made a very major policy mistake by cutting interest rates in September. So that is having a huge impact on how markets trade at the start of this year. Why did the US market do so well? Why did the S&P go up 23 and the Nasdaq more than 30? Well, it's pretty simple. There were strong earnings generally across the board. Earnings met and exceeded expectations and were strong enough to justify certainly most of the valuations. Not all. There are some that are in clad cuckoo land, but most of the earnings growth justified the current valuations. We've also been through a period where inflation is cooling, so the market doing what it does, looks ahead and saw that as a pretty good trend. The American consumer has been surprisingly resilient, and the US economy has also been surprisingly good. And really, if you look around the world, the US economy is the economic outlier. They've had more growth and they've got much better economics than just about everybody else. So that's a pretty good formula for why the market went up as it did. And of course, the icing on the cake, as far as the market is concerned, is that there was a Trump victory in November, and the expectation that Trump policies, whilst unpredictable, will probably lead to a net better outcome. But stress the word probably. I just want to touch on some US market realities that come into play every day and have certainly come into play in the last week or two in the Insiders Club portfolio stocks, where we've seen some quite significant declines on an individual stock basis, only to immediately turn around and bounce back spectacularly. And it's difficult to negotiate that sort of territory for investors because the two things aren't consistent. We get a medium-term sharp decline, and then just as suddenly we see the market or the prices turn around again. And I think part of this, if not all of it, but part of it is the role that passive index funds dominate, and also ETFs. Now, ETFs, and I've been talking about this for years and years and years, can create self-reinforcing spirals, both to the upside and to the downside, where stock prices rise requires ETF fund managers to buy, stock prices decline requires ETF fund managers to raise capital, and prices go down. So it can be a self-reinforcing spiral that just has to play out, and it can go to irrational levels that don't make sense based on fundamentals and valuation. So sometimes you've just got to step back and let these sort of temporary market dynamics play out. That's really the important message here. Now, US bonds are certainly betting that the Fed has got it wrong, because as soon as the Fed cut rates, the US 10-year bond yield started to rise. And we'll take a quick look at that. So there's the 10-year. Let me give you a view over the last 6 months. So September was when the Fed did the first rate cut, and that was basically the bottom at around 3.65. And since then, the 10-year yield has consistently formed higher highs and higher lows and finished the week at 4.77. So that is a pretty telling correlation. We've now got a situation where about 3/4 of that rise in the 10-year rate is due to higher term premiums. So the additional premium that investors demand for the risk they perceive had been in decline for many years. But now we've got a situation where that has recently turned up, and we're now back where the term premium is back above 50 basis points, which is the highest level since 2015. So it begs the question, is this an inflection point? Is this a major turning point in how major players perceive risk in the market? And obviously, we don't know the answer to that yet, but it's certainly one to watch, and it's contributed to the fact that the US funds rate, Fed funds rate, is going down, but the 10-year yield is going up. So that is certainly a very, very important one to watch, because that has enormous ramifications for all asset classes, not just equities. So where we're headed at the moment is the 10-year yield is well and truly on its way to 5%. And yet with the Fed and market expectations talking about 2 more rate cuts, I think the Fed funds rate at the moment is about 4.3. So that would take the Fed funds rate below 4, yet the 10-year yield is above 5. That doesn't make a whole lot of sense. So how that resolves is very important for equities. Now, looking ahead, if being broadly diversified is not the way, and I'm absolutely convinced and have been for a long, long time that being broadly diversified is not the way to manage risk. The way to manage risk effectively is the Warren Buffett method. You do your homework and you watch the stocks that you own very closely, you understand them, and you only invest in the best of the best. So I'm absolutely convinced that broad diversification is not the way, even though it is still sprouted by many so-called experts. So the answer to me is to narrow your focus, is to do your homework. Don't be lazy about your investing, and just make sure that you only own the best of the best. There's so many out there. It's not a challenge to find just the best of the best. The challenge is to put your plan together and to execute it. So high quality and also momentum investing. I mean, there are lots of people, and I used to be one of them a few years back, would scratch their head over the valuations of stocks like Primary, for instance, and several others that are trading, WASTEC Global, Zero, that are trading on multiples of 80, 100 plus. And investors would scratch their head and think, well, that's just silly. No stock can be worth that. But it is now apparent to me in recent years that these stocks just keep on going because the market is rewarding them for being such an outstanding business and providing near certainty about what the future looks like. So do not dismiss momentum as being important in the market. And if you are buying the highest quality stocks that also have extreme momentum to the upside, and you manage risk suitable for yourself, suitable for your psychology, then that remains the standout way to produce above average returns. There's no question about it in my mind. And picking just one aspect, and there are multiple aspects here to what creates the best of the best, but just picking one, stocks that have got pricing power, and pricing power can arise for varying reasons, but stocks that have got pricing power have got that for particular reasons. And so if you can find stocks that have got the ability to raise prices and not lose market share, then that's a heck of a good starting point. Now, of course, there are risks in 2025, and I think they're as large as I've ever seen. We've got the impacts of Trump's tariffs. Who knows where that's going to go? It doesn't really bear thinking about until we start to see it unfold. We've got multiple geopolitical risks that I can't remember in the last 30 or 40 years as many and as significant as we've got. And this is all against a backdrop where valuations in general are not cheap. Now, some stocks are cheap, high growth stocks. Some high growth stocks are expensive. Valuations in general at the index level are certainly, they're not cheap. So we've just got to be mindful of those risks. And again, as I cover every week, one of the key reasons for me doing this is that it's actually really damn easy to lose money in the stock market. It really is. I think it's easier to lose money. I'm in a position where I get to talk to a very wide diversity of investors. And most investors really don't have a game plan. They don't have much experience in doing things properly. And so for them, it's incredibly easy to lose money. And that's why it's so important to have your game plan clear and to get focused on it and not to be thrown offline by the headlines like what I started this presentation with. All right, let's get on to American stocks now. The S&P fell 2% for the week. The Nasdaq was down by just a little bit more. So it was a holiday shortened week, but it was still negative. And the Russell 2000 for small caps was down another 3.4. I think it was down about 8% last week. And of course, that was punctured by a hotter than expected jobs report on Friday night. And that is going to be a problem for markets in this adjustment. They were expecting 3, possibly 4 Fed rate cuts in 2025. 2 looks to be almost optimistic now. And in some quarters, they're even talking about a rate hike. And that would certainly put the cat amongst the pigeons, that's for sure. The US dollar continued its breakout and is up almost to 110. The 10-year yield, 4.77, as I covered, and the VIX is at 19.5. So let's take a look at some charts. This is a weekly chart of the S&P. So you can see we've had 2 sharp weeks down. One was the week ending the 20th of December, but last week was quite emphatic. And if we look at IWM, you can see it's not had a particularly good time of it over the last couple of weeks. If we look at the NASDAQ, it's actually looking a little better than the S&P. So what I saw in going through at least 100 US stock charts, both small and large, so the Microsofts, the Amazons, and a whole bunch of small cap stocks, is that so many stocks didn't go down by very much and only did so on small volumes and quite indecisively. And I'm talking about some of the more major tech stocks. So I just didn't see the sort of real negativity in the market that I expected to see when I got up on Saturday morning and saw the index result. I expected to see a lot worse in terms of individual stock charts. So I was pleased and impressed that so many stocks, both large and small, actually did okay. And there were quite a few that were actually in the green. Quite a few within the Insiders Club US portfolio that actually would break even or better. Always important to look at semiconductors, and you can see semiconductors were down. It ended up down slightly on the week after starting well, but it's still consolidating, is really what you've got to say about semiconductors. With a big surge that started in November of 2023, and we've been consolidating since the middle of last year. Now, if you look at the relative comparison charts, consumer discretionary is still at the top of the pack, but it's been trending down. So is communication services. In fact, pretty much everything is trending down in the very recent week or two. Not a lot of positivity around the US market, and that really reflects the whole picture, all the things that I've talked about, plus the uncertainty of, Trump's going to be in the chair in 8 days, and who knows what the heck he's going to do. Interesting times. In Australia, our index held up reasonably well thanks to the banks, also the information technology sector. But the order of performance in the Australian market has not really changed much in the last few months. I'll just have a look at the currencies while I'm here. So this is the US dollar index on a weekly chart. So you can see it was only 4th of October that the US dollar was trading down at 100. And then, of course, associated with the Fed rate cuts, we've now moved from 100 to nearly 110. That's a huge move for a currency. And the Australian dollar, importantly, is now broken support. So we had important support here at 61.3. The next really critical level is 57.6, and there really isn't anything in between. And we're talking about all-time lows here. And if you look at that chart, you would have to say that the odds are that the current trend prevails and the Australian dollar which has just broken support. Now, this could turn out to be a false break and we bounce from here. But at the moment, as you look at that chart and put all the ifs and buts aside, you have to say the Australian dollar is on its way to 57. And that will be a massive problem for the Australian economy. So that's not a particularly good situation. So 60.86 is where we finished. And as a consequence, and this is not a political statement because I'm not sure any side of politics have got the answers, but we should be seriously questioning the economic policy that whatever side of politics rolls out of us, because money markets are voting that we've got it very, very badly wrong, and our standard of living is going to suffer accordingly. The ASX 200 rising 0.53% for the week, but I suspect some of that gloss will come off, and that's largely due to the banks. The upward momentum that we saw in most of the final quarter of last year has certainly slowed sharply. But look, the best of the best that I keep talking about all the time, the stocks that you should narrow your focus to, they are prevailing. There are some very, very good ongoing trends. And if they're in consolidation at the moment, then those trends will probably reassert themselves. And we're seeing quite a lot of that at the moment with high-level consolidation where the stock price has moved up very strongly but hasn't really retraced very far. It's just gone sideways for a period at a high level, and generally the next move will be to the upside. Turning to precious metals, gold was up $50, almost to $2,700, so a pretty good week for gold stocks. And with the plunging Australian dollar, in Aussie dollars, gold is at almost 4,400. It's incredibly profitable territory for Australian gold miners. Silver back over $30. And if we look at the big picture, there is a local trend higher of sorts, but it's pretty tame. And it's well short of what should be, considering the Australian dollar gold price is almost $4,400. Local gold stocks should be just leaping off the page, but they're not, so that's pretty disappointing. And if you look at, just as one example, Northern Star, as one of our bigger gold stocks, is trading at less than, I looked at the PE multiples that Northern Star has traded on over the last decade, and it's trading at less than 50% of the normal multiple that it would trade at. I think that, in essence, is the issue for the Australian gold stocks, for Australian gold producers. And globally, it looks even worse. So let's go and have a look at those, some of those charts. First of all, so there's GDX. So this is the Aussie index. Moved up a little bit over the last couple of weeks, but you'd hardly call that reflective of the fact that the Australian dollar gold price is at 4,400. And if we look at GDXJ, which is more of a global reflection of what's happening with gold stocks, then that's just awful, considering gold is at $2,700. So let's go and look at the gold price. So that's in US dollars on a daily basis. And if I switch that to a weekly, you can see it's a strong uptrend. Yes, we've had a consolidation since the 1st of November. So the last 2 and a bit months have been slightly down to sideways. And that can obviously colour your thinking because of recency bias. But you've got to step back and say that the gold price is trending very, very strongly. And gold stocks should just be doing one heck of a lot better than they are. There's a silver price. It's languished a little bit. Has been lurking around this $30 mark now for some time. And if we look at the Australian dollar gold price, there we go. So we've now broken out of another consolidation, and it's been a heck of a move in February. So basically, let's go back 12 months. So we'll go back to the 12th of January 2024. The Australian dollar gold price was $3,050. We're now almost at 4,400. That's almost 50% rise. Now, whilst the costs for Australian gold producers have risen, I'd like to bet a lot of money that those costs haven't risen by anywhere near 50%. So Australian gold stocks, on a fundamental valuation basis, are looking very, very cheap. Turning now to other commodities, copper has done really well, snuck up from barely $4 back to $4.30. And nickel is pushed up a little bit, but it's still below $7. So this has been a pretty decent bounce in copper, but there's still plenty of headwinds. So I'm not getting too excited about copper just yet. And of course, the strong US dollar is not helping, but that is a bit insightful given that the US dollar's just moved up quite strongly, but copper has also rebounded as well by the best part of 7 or 8%. So maybe a few green shoots there for the copper bulls. And crude oil up again to 76.5. So there's the copper chart, quite a sharp bounce in the last week. Wrapping it up, where to focus in the midst of the uncertainty that 2025 is almost certainly going to bring. Now, if rates are going to be higher for longer, which even though rates may go down, I think it's highly likely now that rates will be higher than what was thought 3 months ago or 6 months ago. So if rates are going to be higher than previously thought and therefore previously priced into equities markets, then to me, it's a pretty simple equation. You just go and find the stocks where the growth in their earnings, the earnings per share growth, far exceeds other concerns that the market might have, and also where that earnings per share growth is highly likely. Investing is not complicated. Investing is really quite simple. It's hard to do because it really stresses what we think should be the way it is. And you've just got to find a different mentality, a different perspective to be a successful investor. So just go and do that. Just go and do the simple things well. You can do much better than the vast majority of other investors. You just got to think differently. And coming back to the very first point I made in this video, just beware of what headlines you digest, because they do get into your subconscious and they do influence your decision making. And if you allow that to happen, your results are going to be far, far worse as a consequence. Portfolio analysts this week, we're getting back to the normal schedule. So for anyone that would like to see more about what I do and how I do things and how I analyse, then there's a $1 trial for 2 weeks is an opportunity to study my methods and see if you like what I do. So that's it for this week. More information on the website. There's an email address. It'll be back with you next Sunday. Cheers.